Hello, my name is Austin Frazier, and we'd like to welcome you to our second quarter 2025 market outlook. Some of you joining us may be our clients, and others are not. Whatever the case may be, we hope that you see value in the viewpoints from our advisors here at Capital Strategies Group. As certified financial planner practitioners, we take an unbiased fiduciary approach to the way that we help our clients. We're constantly keeping an eye on market movements and staying updated through various resources. We'd love to share our insights with you, but it's important to note that just because we're discussing these topics doesn't necessarily mean that adjustments are warranted in your portfolio. News headlines can sometimes create a sense of urgency to take action, but it's important to recognize that not every situation necessitates immediate action or intervention. A lot has happened since we last spoke. Let's start out by talking about tariffs, since they've been making quite a few headlines. President Trump has announced 10% tariffs on almost all U.S. trading partners, including higher reciprocal tariffs on specific countries like China and the European Union. What does this mean for the economy and the markets? Well, tariffs are essentially taxes on imported goods, and they can nudge up prices for things like groceries, cars, or energy. The concern with this, of course, is that it can increase prices for goods that we buy every day, which in turn increase inflation, slows economic growth, and can potentially cause a recession. However, businesses will often adapt to these changes. Some businesses absorb the cost of tariff increases to stay competitive. Others shift supply chains. And in some cases, domestic production will step in to fill the gaps. Some may be worried about the effects of tariff on food prices, but the good news is that staples like chicken, beef, bread, corn, milk are all mostly grown in the US, so they're more insulated from these tariffs. Analysts believe that the uncertainty around tariffs is a bigger risk than the tariff themselves. This is mostly due to the lack of clarity around the duration of the announced tariffs and who will absorb most of the price increases. It's still too early to determine whether the imposition of certain reciprocal tariffs is a negotiation tactic or a long-term policy tool. You've probably also heard talks of a recession as a result of tariffs. So let's talk about what this means. A recession is defined as 2 consecutive quarters of shrinking GDP. A recession can cause companies to slow growth, trim jobs, and cause consumers to cool their spending. But here's the reality. Recessions don't come about just because of how people feel. It's the data that determines this. Yes, sentiments have been a bit down lately, but consumers are still spending. The job market is still holding strong, and unemployment is slightly above 4%, which is well below the long-term average of 5.5%. And new jobs are still being created despite the trimming that's happening in the US government workforce. Although the economy may not be on pace for the same aggressive growth that we saw last year, economists still predict modest GDP growth for the full year. What else is available to help the US economy remain stable during times like this? Well, the Federal Reserve is uniquely positioned for this very purpose, to control inflation and reduce the risk of a recession. They are watching this closely and have the tools to manage it. Through adjusting interest rates, they can moderate inflation and reduce the severity and longevity of an economic slowdown. The market has weathered through geopolitical events like this in the past. One chart that I really like is this one that shows how geopolitical sell-offs are typically short-lived. As you look across this chart, you can see different historical geopolitical events and the resulting impact that they had on the stock market. The yellow bar represents the initial sell-off that occurred upon receiving the news, while the light green bar represents where the stock market was 6 months later. And the dark green bar represents where the stock market was 12 months later. As you look across these different geopolitical events, you can see that the majority of the time, within 6 months, the market has taken back the losses experienced on the initial news. On the top left, you can see that on average, the market has had a positive 5% return within 6 months of a sell-off, and a positive 8% return within 12 months of a sell-off. Although the past can't necessarily predict the future, It's comforting to know that many notable geopolitical events in the past have been short-lived. We believe diversification remains the best approach to confronting market volatility, regardless of what might be causing short-term market moves. Markets reprice faster than you can change your portfolio. So reacting to headlines is not a good investment strategy. But preparing for them by being in a diversified portfolio is a good strategy. For our clients, you can take comfort in knowing that we have planned for this from the beginning. From the top down, your portfolio is carefully designed with the right mix of investments, diversified across the full spectrum, to optimize for stability and growth. We know that times like these inevitably will come, but we've designed your portfolio in the best way possible to weather the storm. We appreciate you taking time to join us for this Q2 Economic and Market Outlook. If you aren't currently a client of Capital Strategies Group and would benefit from having an expert at the helm helping you navigate the challenging market landscape, we invite you to reach out to us. Take care and thank you for watching.